Hello, it's Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for June 28th of 2026. Start off in the chart pack this week. We have the final revision for the first quarter GDP number. The second revision was actually revised down to 1.6%. That is the previous estimate there. And then the final revision, it was revised up again to 2.1%. So the final number for first quarter is 2.1. And we can see here, over here on the right, some of those changes. And really the most material one I'd say is that trade, as it were, as a net drag to overall economic performance, was revised to be less adversely impactful, I guess would be the best way to say it, than in the prior estimate. You can see that imports were revised down, and so that had a correspondingly positive impact on the effect of net negative trade on GDP. The other thing that is maybe perhaps more impactful over the long term, if this is sustainable, is consumption was revised down from the prior reading of 0.9% contribution to 0.4% contribution. So that is actually a bit of a material revision downward in consumption. So obviously we want to make sure that that's, to the extent that that's habit forming, whether we see that kind of weakness manifest in the second quarter. Again, we will know that at least the first reading will come out in the third week of next month. But in any case, GDP in the final estimate was a little bit better than expected. We have real disposable income. We did see a tick up, but the overall trend remains fairly weak. We've got personal consumption expenditures, 0.3%. Both of these are real numbers, meaning that they are inflation adjusted. So personal consumption expenditures, PCE, as it were, was somewhat positive, an interim positive reading here in disposable income, but we're still finding a negative trend in terms of that growth. Spending on services, rather interestingly enough, we've seen growth rates in that area really stall out quite a bit, and you can see that this has had a fairly meaningful impact on the overall total real consumer spending. Here, these are goods. We did see kind of a net neutral impact, a slightly negative impact here towards the beginning of the year. We're seeing rather stark resurgence in good spending, which is a positive thing, but that's coming in the face of negative services trends there. And you can see the savings rate now down to 3.0%. Long-term average, obviously higher than that, but had been trending down before we hit the global financial crisis, and then the anomaly here related to the pandemic with all the transfer payments and whatnot. But again, people are spending into their savings to help support consumption, which right now is really heavily favoring the goods sector. PCE prices, this is the inflation measures that the Fed pays attention to. You can see we have for the monthly number, it was just ever so slightly below expectations. Here, the core PCE number came in pretty much right in line. As you can see, an overall trend a little bit higher than what we saw over a multi-year period. Now, if you look at the trailing numbers that are annualized, you've got 1 month annualized right around 4%. And if you annualize the 3 month trend, that's about 3.5 to 6 month, that would be 4.1%. So you can see here that overall year over year about 3.4%. So all in all, we've moved higher from kind of that 3 level, which we were stuck at for some time, and we're roughly tracking about a half to a full percentage point higher than that now. Durable goods orders, this backs out transportation. Pretty solid number here, all in all. The airline orders in the all-in durable goods numbers made this a little kind of wonky, but when you back out transportation, again, pretty solid trends here. Here's core capital goods shipment numbers in the black line, continue to move higher. This is one of those proverbial green shoots in this economy that you look at it on its face, and it would certainly help to make you a little bit more enthusiastic about things. You can see ISM manufacturing falling in line. There's a really good relationship in these numbers. And then if you get down to, these are shipments, so you get down to orders, also positive. You can see that uptrend in both of these time series as it relates to ISM manufacturing new orders, again, tracking overall cap goods orders there. So this slide, very positive. Atlanta Fed is further revising down its estimate of second quarter GDP, which, as I said a few slides ago, we'll get the first reading of in the third week of July. Right now, looking about 2.5%, and that was down from an original reading of about 3.7, 3.8, and then we went above 4 there for a little while before having that revised down fairly significantly. We talk about the K-shaped economy. This is something that kind of speaks a little bit to that. So this is kind of a share of wealth that's kind of like normalized back to the global financial crisis there in 2008. You can see the top, basically the top, 0.1%. They've seen some rather meaningful gains in wealth since the pandemic. Obviously, a lot of these people have very broad exposure to the stock market, which has done arguably fairly well, with the exception of 2022. You can see in the other line, which is basically the 99, anyway, that another top tier, not as much as the top 1/10 of 1%. And you can see the bottom 90% were exhibiting or experiencing greater wealth generation, and then that has trickled off at the same time that the we'll call it the haves have been increasing their share. So again, the rather unequal distribution of wealth gains amongst various income cohorts. We have Oxford Economics Business Cycle Indicator. You can see here the shaded lines represent recessions. Obviously, 2008, that was a very negative indicator. And we've had some downward trends here since then in that long decade following the global financial crisis, but nothing that really penetrated this recessionary threshold here. And until we got to the pandemic, and that was, again, a rather stark dislocation of resources, et cetera. Now, we did have, some negative data points here, kind of like before and just after the beginning of the year, but we've since picked up. So, in the one sense, you say, yes, we have touched here. The recessionary forecasts are still pretty low because of things like I just showed you on the durable goods side. Those orders and shipments are looking pretty good overall. Again, not every sector of the economy is doing as well as that, but the bottom line here is with this uptick right here, it doesn't seem to be a durable, any kind of a durable recessionary signal yet, even though we've seen it straddle this threshold. CFO survey. So chief financial officers are generally feeling a lot more optimistic about their own company than they are necessarily about the economy overall. And I'd say that kind of trickles into kind of like, what their most pressing concerns are and how that's changed. So this is going back to the first quarter of the year, and the dark blue represents the second quarter. You can see here, inflation much more of an issue to them. Non-labor costs, you talk about, supply chain and those things, which we know we've had some choke points there. We've had some increased costs for some of the obvious reasons related to the Iranian conflict. Obviously, that is a much bigger issue to them. Geopolitical risk, much more of an issue. Trade and tariffs, oddly enough, is less of an issue than it was. That seems to have died down and been replaced by geopolitical tensions overall. But these are two very material components of the cost structure, inflation and non-labor. So obviously continue to monitor that, but overall confidence remains relatively high for individual companies from a CFO perspective. Talk about new home sales. This has really been a theme for the better part of the year, that this just remains stuck. With buyer affordability is really not that great. We've seen interest rates and mortgage rates move a little bit higher. You can see home sales growth rates are entirely negative at this moment, and continue to show those negative trends. And over here, another interesting development amidst the affordability problem and the new home sale turnover is that we have really a strong supply of new homes for sale. And so that's putting a lot of pressure on builders to provide incentives for people to take those homes off the market. And so they're taking hits in their margin and profitability to try to move those homes. But even though those inventories may have come down here a little bit in this latest set of readings, you can see that the overall trend was positive in terms of inventory accumulation, and obviously translating into negative implications for the home builders. Here we have architectural billings index. That remains in the negative. This really does not particularly, it's not particularly encouraging for commercial construction. That's not to say that all commercial construction is materially in an adverse position. We see a lot of kind of like low-rise flex use industrial type space that's still doing fairly well. Obviously, offices are not in vogue right now. We still have a lot of absorption left for vacancies. And what this tells you is that overall in the commercial real estate sector, you just don't have as much impetus to do new construction these days. Kansas City Fed, another green shoot here, we'll call it, tracking positive in an increasing way. This composite number is actually pretty positive here. And then you look at new orders within the Kansas City Fed region. You've got both current and future orders tracking positively, even though this has come off a little bit of an interim peak here, but numbers are indeed positive. Now we talk about the energy shock and what's going on with Iran. A lot of noise here in the headlines. Of course, it seems like every day there's a new wrinkle to this whole ceasefire story. But what is clear at the moment is that we're seeing crude prices that are moving down, and you can see that at the pump. I think prices at the pump that I usually frequent are down, at least 30 to 40 cents a gallon right now in terms of the distillate gasoline product that's cracked off of this crude that is in question here in this green line. However, having said that, 2-year yields remain high. They remain sticky. The inflation picture, which had been influenced by higher crude prices, that seems to have mitigated for the moment, but overall rates seem to want to remain higher for longer, as is implicated in the headline here from the slide that I lifted off Apollo, and give credit to them for this analysis. But this is as you can see, going back at least, probably 6 to 9 months, perhaps, that this gap is widening out at a fairly interesting rate. And like most of these time series that have reasonable correlation. Again, this is 6 months is not a tremendous length of time for correlation, but when you have this kind of deviation, usually one of things can happen. Either yields come down, or you've got prices that are coming back up. But in this case, it really is interesting to watch. And higher interest rates do have a lot of implications, as we talked about, for mortgage rates, for borrowing costs, so on and so forth, even though it's good for savers. Well, we were just talking about the crude prices here. You can see this is data regarding the Strait of Hormuz. And as I mentioned before, the news flow seems to be fairly fluid. There seems to be breaches to the ceasefire, and I don't even know if you can even call it a ceasefire anymore. It's just kind of a, it's more rhetoric than it is substance. But in any case, you can see for a while, obviously things were really kind of shut down here in the Hormuz Strait. Recently picked up from a crude perspective. These are, basically crossings. These are westbound crossings in this line down here, which are going down and tracking negative. But you got total commercial crossings, which have picked up a little bit. And you can see that manifested over here too a little bit. You've got fertilizer exports. We know urea and potash and some of those things that are typically, shipped through Hormuz. Outside of crude, probably fertilizers and other agricultural products are probably the most commonly transported things through Hormuz. But the good news is here that it seems to be picking up a little bit off of a fairly low or minimal base. As we continue on with the energy topics here in this dotted line here, that represents the current year fuel inventory for distillate products, of which gasoline is one of them. So just for those of you who don't know, you take crude oil and you crack it into its various distillate products. So you've got basically lubrication oil, you've got gasoline, kerosene, and you have other products that come out of crude when you crack it in a refinery. And you can see here that because we have seen lower crude inventories, that correspondingly you see distillate fuel oil inventories remain low as well. And again, the headline, as it suggests here, we've got really good demand here in the U.S. And because of a reasonable economy, and then you've got the issues related to Europe because of some of the closures and some of the choke points in supply. Now we'll talk about some of the, the more salient points of what's going on here with Hormuz and shipping. And basically you have other areas. You've got over in the Red Sea. Now you've got the Houthi rebels which sympathize with Iran. You don't hear that much about it, but they are causing a little trouble. So you've got some choke points there too. But you can see here in this chart, basically you've got a little bit of an uptick here in container freight rates. Again, nothing like the displacement factor that we had in 2020, 2021 because of the pandemic. But they are on the rise again, so we should definitely continue to watch this. We've got truck transportation costs rising. This is a little bit more of a delta than what we saw in the last slide. So whether you look at specialized trucking, refrigerated, or flatbeds, they're all moving higher at this point. So at some point, these costs do have to get passed along. Daily transit volumes at the Cape of Good Hope and the Suez Canal. So we've got two data series here plotted on this. So Suez Canal, as I said, you've got choke points in the Red Sea now. So you see transport volumes that have really come down off of where they were. And as a result, you see people that are actually willing to pay more to go essentially to take the decidedly more southern route to transport around, basically from Europe to Asia here. And you can see that those volumes are offsetting the weakness here in the Suez. Supply chain index. This is kind of a bit of a broader measure from the New York Fed. This is kind of obviously something that we spent a lot of time looking at during the post-pandemic supply chain problem, and they're on the march again. So these things had mitigated for a while, and then you saw some fairly muted data points overall for a while, and then they have now picked up again. So where these were negative for a couple of years here, you're seeing the supply chain pressures move up along with inflation, which is this line here. This is a consumer price index. So you've got the global supply chain pressures moving now in tandem with inflation. Here we have inventory to sales ratios that are falling. This might be good for economic growth as we head into the second half of the year, just because when inventory levels get low and you have and you're not justified for holding lower inventories because your demand is fairly strong, that would lead to inventory rebuild, which would be a contributor to economic growth in the second half if we had it. But right now, inventory to sales ratios are dropping, I think, partly because the demand has been so strong. Interesting couple of charts here from Statista. This is really just kind of captures the generational change and where young people's mindset is right now with regard to housing. So, the percent that think it's a good time to buy has really dropped, even though it's come off of its low. You've got 29%, and that number was like 70% basically about 10 years ago. And conversely, those who feel it's a bad time, it was very low 10 years ago. Now it's relatively high. And so we see that saw that inflection post-pandemic. And again, with the home price increases and interest rate increases, you see that percentage of those who think it's a good time to buy is really low right now. Now, the other thing too, which I thought was really very interesting, and this is really more of a generational statistical analysis, that you've got a rising number of younger folks aged 18 to 34 who actually don't think that they're going to be buying a home in the foreseeable future. And you can see that that's almost a threefold rise going back roughly 10, 11 years ago. And you can see that trend has definitely accelerated. And here we look at 2025, 2026. You have a far less number that are expecting to buy a home here in the next 5 years, and a much higher number in 10 years. And as I said, even a higher rate of growth in those who feel like they don't have any visibility towards buying a home. Quick chart on data center construction. This is one of those that just gets your attention. You can see, again, we've got a lot of capital spending coming, which I think will be beneficial. It'll be one of those things that helps to at least backstop the economy to some extent, even though some of those who are spending the dollars to build data centers are witnessing free cash flow yields that are declining. But this number definitely is helping to sustain the economy, certainly helping to sustain investor sentiment in the overall economy as well. Quick gut check here on really kind of all things stock market, really. And so when you look at this, you've got a dollar that you put in 1941 when World War II started. And, again, you have hiccups and bumps along the way, but again, the long term is very compelling. And as all these little red notations will remind us that, we've had a lot of conflict, we've had a lot of, like international interventions and wars, and, we've had a lot going on, and the market does factor that in when it's relevant. Oftentimes we see when the conflicts are relatively short, it doesn't really have a material impact on the market, certainly not a lasting impact. But again, if you can put up with interim, pockets of volatility, the long-term trend is up. And again, $1 put in 1941 is now worth 14,228 today. Total returns, this is really compelling as well. You've got negative return in the Mag 7. Though those were the darlings, certainly 2 years ago and to a lesser extent last year, but definitely lagging the basket of other technology and semiconductor stocks here, and which are depicted in the light blue line here, and those have basically gone up more than 100%. Here we have the active managers index continues to move higher, so there's greater optimism amongst the institutional investors. As we look at the individual investor sentiment, that continues to move higher as well. Bearish sentiment continues to move lower. So, after two fairly, remarkable points of bearish sentiment, we've turned back to kind of a wholesale bullish sentiment, at least from an individual investor perspective, which matches the optimistic sentiment that we get from active managers on the institutional side. We talked about gold. Stocks underperformance of gold, was rather remarkable towards the latter half of last year. Stocks have actually continued to melt up, as we all know, because of what we talked about in the last slide, semiconductors, so on and so forth. And gold has shown a little bit of weakness off of its top. And honestly, I think it just got a little too overheated, got ahead of itself here. But you can see the relative outperformance of gold is certainly in reverse right now. And again, another one of these things that kind of helps to remind us of the fact that there are a lot of companies in the market other than the semiconductor stocks this year that actually we've had almost 54% of stocks in the index are underperforming the index itself. And about 38% are actually negative on the year when this index has been positive. And so this just helps to remind us that diversification really is beneficial at a point where the quote unquote stock market is moving higher. Internally, not everything is moving in that same direction. And so it's important when you take some sector bets and some factor bets that you have kind of a multi-year view in mind. Here we have the forward PE. Again, as we've said multiple times over the last month or so, stocks are not cheap. They aren't expensive as they were. They've come down, and a lot of the reason for that is that earnings continue to move higher. And so when you have price divided by earnings and your earnings goes up, then your PE multiple shrinks. And so we've actually had, even though stocks have continued to move higher, we've actually had multiple contraction because earnings have been so strong. But make no mistake, U.S. stocks are not inexpensive. Here we have some relative numbers for sectors, as I alluded to a couple of slides ago. Again, not everything moves in tandem. So here's the consumer discretionary versus the overall index. Again, consumer discretionary stocks have underperformed. And we also had industrials that were underperforming for a while, but they've picked back up now. So that has kind of reversed itself. Now we have financial stocks that have done quite well overall. And here we've got material stocks versus the S&P 500, which have only recently begun to show a little bit of strength. We talk about growth versus value. Growth factor, oddly enough, was really performing well at a time where value was underperforming. That was basically in 2025. So far in 2026, we've actually seen value outperform, and we've seen growth underperform to some degree. So I mentioned the Mag 7 is actually negative for the year, and you can see that that those stocks have the price to earnings premium, not the aggregate price to earnings, but the premium over the rest of the market. It continues to decline here as those stocks come back to earth a little bit more. Here we have free cash flow for those hyperscalers that were building all those data centers that I showed you a few slides ago, and I'd mentioned the cash flow, free cash flow was declining. You can see that very well depicted here. You've got Oracle that is in negative free cash flow right now, but all of those hyperscalers are witnessing declining free cash flow at the moment. Software gets a lot of mention for its impact in the private credit space. You can see here, software trades at its lowest value in a long time. This is basically the iShare for the software, and you can see how weak that is relative to the overall S&P 500. And again, this is something that has been playing out for a number of years now, but has picked up quite a bit more steam here just this year as some of the speculation is that AI will basically obviate some of these software business models because of the agentics involved will replace some of the tasks and reasons for being for some of these software platforms. So that's where we're getting the stress in software now. Here we have the 10-year Treasury yield, as I mentioned, continues to move up. This is beneficial for savers, not so good for buyers. 10-year rates moving higher also makes mortgage rates move higher because the 10 years what they're indexed to. And so this is an issue, higher for longer. It's had some help in reversing the trends in the dollar by making the dollar a little bit stronger. But at the same time, that seems to be offset a little bit by the fact that you've got some central banks that are now already hiking, even though I think we're still in a holding pattern here in the U.S. for Federal Reserve monetary policy. But I think the chances of a rate increase have certainly moved a little bit higher here in the last few weeks. Talk about distress index. It's very interesting here. One thing I want to point out, high yield, the lesser credit-worthy companies have actually seen their distress index go lower. It's very counterintuitive. If you feel like there's overall stress in the market, again, we just talked about those software companies and the software issuers. But this is not showing any kind of a recession indicator whatsoever here. But oddly enough, with investment grade, you see that stress or distress index actually move a little bit higher. And this, again, this is very counterintuitive. But we have seen periods where that has been the case. So not overly alarming, but it just seems like we would have more distress in high yield than what's been exhibited. And actually, if you look at where we are now in the overall levels, I mean, you got to go back to 2018 really to find levels like that, because we're actually below some of these valleys right here. You've got to go all the way back to 2018 for that. Here we have the notation from BCA, and we're talking about a lot of different things here, but this is 12-month trailing speculative grade default rate. So we can see here that even though the last slide we saw, overall distress was not that high. We are seeing an increase in default rates, but just like we saw in that last slide, option adjusted spreads are very low. So the market's not pricing in the fact that the solid line is going to be habit forming. It's going to keep moving higher. It's really pricing in kind of a leveling off of defaults. And in Europe, you see very much the same thing. Where you have speculative grade defaults that are moving higher. but spreads are still moving lower. And as we slide over here, these are, when you talk about like the impact of, like credit, whether it's high yield or not, you obviously have to incorporate what's going on with the business development companies. And this is where there is some stress in the market, and which I think is actually overblown. Now, some of these BDCs or business development companies, if you will, that are traded have been under quite a bit of stress lately because of fears that their software exposure, like we've been talking about, is going to increase and it's going to become a problem for earnings. But again, what that is doing is it's causing these BDCs to trade well below their book value. Right now, they're trading at almost right here about a what is that, about a 17, 18% discount to net asset value. Like we were just mentioning, private credit has been under a lot of scrutiny lately. You can see here in this chart from Apollo that really that's because of the smaller funds that are probably not able to avail themselves to the best deals. They're not getting the best deals that some of the big funds are. You can see here that the markdowns in principal of some of these loans is not nearly as great. In fact, it's very flat when you look at the overall large firms. It's these small firms that are trying to stick their neck into the market and be competitive, where they're just not getting access to the best credits. That's where we're seeing more of that overall markdown stress. So as we tie private credit back to the overall kind of like health of credit as well, and the impact of higher interest rates, and just keep in mind what I mentioned a few slides ago, that the 10-year yields remain sticky, even though a lot of the inflationary impulse that would be driven by energy has abated. Now, again, there's a lot of uncertainties, but rates are higher, and I think they're higher for longer. And what this slide tells you is that companies that have pretty high overall leverage and low ability to cover. So I'd say that box is probably like right here. And here you see software, in a couple of flavors here. You've got diversified consumer services, healthcare providers, a little bit more in the crosshairs, but their coverage ratios are higher. And these are the companies that are probably in the best shape. These are the sectors of the economy that are in the best shape with regard to the issue of rates being higher for longer. But just to highlight that this is why software is so much under the microscope right now. That's all we have for the chart pack this week. I hope you have a wonderful week and a very safe and enjoyable 4th of July. And we'll catch up with you next week. Take care.